What makes markets stay irrational longer than expected? Welcome to this insightful discussion about one of the most puzzling concepts in investing: market irrationality. Why do markets often behave in ways that seem detached from logic or fundamentals? Why do they surge despite negative news or crash when all signs point to growth? And most importantly, why does this irrationality persist longer than we expect? This video will unpack these questions and equip you with strategies to navigate irrational markets successfully, so you stay calm, rational, and focused on your investment goals. Market irrationality occurs when asset prices defy logical or fundamental valuation principles. Instead of reflecting the intrinsic value of assets, markets are driven by emotions, speculation, and external events. For example, stocks may climb to unsustainable highs during bubbles or plunge to undervalued lows during panics. For investors, this irrationality can be perplexing and even paralyzing. Understanding why markets behave irrationally is critical. By doing so, you can avoid making costly decisions driven by emotion and instead build a foundation for long-term success. Throughout this video, we'll explore the factors that fuel market irrationality, why it lasts longer than anticipated, and how you can develop strategies to navigate such challenging periods. Human psychology plays a significant role in driving market behavior. While we like to think of the financial market as a rational system, the reality is far from it. Instead, markets are largely influenced by the emotions and biases of millions of investors acting in their own self-interest. Two emotions dominate market behavior: fear and greed. Fear causes investors to sell prematurely, often at a loss, to avoid further declines. On the other hand, greed pushes investors to buy assets at inflated prices, hoping for even greater profits. These emotions can magnify market volatility, creating dramatic price swings unrelated to the true value of the assets. Investors are also influenced by psychological biases that distort their decision-making. One of the most common is recency bias, where people give disproportionate weight to recent events over historical trends or long-term fundamentals. For example, a short-term dip in the market might lead investors to believe a prolonged downturn is inevitable, even if larger trends remain intact. When emotions such as fear and greed spread through the market, they lead to herd behavior. Investors tend to follow the crowd, buying during frenzies and selling during panics. This collective behavior often drives prices further away from their intrinsic value. While investor psychology is central to market irrationality, external factors also contribute significantly to prolonging irrational periods. Central banks play a crucial role in shaping market conditions. Policies like low interest rates or quantitative easing can inject massive liquidity into markets, creating an environment of risk-taking and overconfidence. For example, during times of monetary easing, investors seeking higher returns often pour money into riskier assets, driving their prices beyond reasonable limits. Periods of high market optimism attract speculative capital, money invested with the sole goal of quick profits. This speculative capital fuels the formation of bubbles, where asset prices rise based on exuberance rather than fundamentals. These bubbles can remain inflated for years as more investors, often fueled by the fear of missing out, FOMO, join the frenzy. Government policies, geopolitical developments, and global crises can also influence market irrationality. Wars, pandemics, or unexpected policy changes often cause sharp market reactions that may not reflect the true economic repercussions. For example, the COVID-19 pandemic initially triggered massive sell-offs, but markets rebounded quickly in an irrational frenzy driven by fiscal stimulus and investor optimism. Advancements in technology have added new dimensions to market irrationality, often amplifying extreme trends. Algorithmic trading allows computers to execute trades at lightning speed based on preset conditions. While this streamlines trading, it can exacerbate short-term volatility. High-frequency trading, a subset of algorithmic trading, magnifies price swings by executing millions of trades in microseconds, profiting from minute price fluctuations. Social media platforms like Twitter, TikTok, and Reddit have become significant forces in modern-day markets. Viral narratives on platforms like Reddit's Wall Street Bets have shown how online communities can drive massive price movements, as seen in the GameStop short squeeze of 2021. Such movements often have little to do with a company's financial health and more to do with collective speculation. To solidify our understanding, let's examine some notable instances of market irrationality throughout history. In the late 1990s, the rise of the internet led to unprecedented excitement about technology stocks. Companies with little to no revenue were valued in the billions, driven purely by speculative optimism. Predictably, the bubble burst in early 2000, wiping out trillions of dollars in market value. Leading up to 2008, blind faith in rising housing prices resulted in excessive borrowing and the proliferation of high-risk subprime mortgages. When the housing bubble collapsed, financial markets experienced one of the worst crises in history. Yet, many ignored the warning signs contributing to its severity. Fast forward to recent years, the GameStop short squeeze in 2021 and the explosive volatility of cryptocurrencies illustrate how retail investors, fueled by social media and FOMO, can create irrational trends. While market irrationality can be fascinating to observe, it presents serious pitfalls for investors. Panic selling during downturns often locks in losses that could have been avoided by holding steady. Fear clouds judgment and leads to impulsive decisions that undermine long-term goals. Equally dangerous is chasing trends in speculative, overvalued assets. By the time most people join the hype, prices are often near their peak, which can lead to significant losses when the bubble bursts. The silver lining is this: market irrationality doesn't have to derail your investment journey. With the right strategies, you can navigate these periods confidently. Maintaining discipline during market irrationality is crucial. Stick to your investment strategy, even when emotions and external pressures tempt you to deviate. Patience, too, is essential. It may take time, but irrational markets eventually revert to rationality. Rather than being swayed by short-term trends, focus on the underlying fundamentals of your investments. Analyze metrics like revenue, profit margins, and growth potential to assess whether an asset is truly worth its price. Resist the temptation to time the market, as predicting exact tops or bottoms is nearly impossible. Instead, adopt a long-term perspective, recognizing that temporary irrationality is part of the investment landscape. Now, let's look at specific strategies that can help you thrive during periods of market irrationality. Diversification minimizes risk by spreading investments across various asset classes and sectors. By doing so, you reduce the impact of irrational behavior in any one area on your overall portfolio. Develop a clear financial plan aligned with your goals, risk tolerance, and time horizon. Having a plan in place provides a structured approach to decision-making during volatile markets. Regularly assess whether your portfolio can withstand market downturns. If necessary, rebalance by reducing exposure to overly speculative assets and increasing allocation to safer options. One of the most frustrating aspects of market irrationality is its unpredictably long duration. Bubbles can stay inflated for years and panics can drag on despite improving fundamentals. Recognizing this can prevent you from making reactive decisions. Irrationality doesn't follow a schedule, and patience is your best ally in enduring it. Market irrationality is an inevitable aspect of investing, but understanding its causes and trajectory can give you a significant edge. By recognizing the psychological and external drivers of irrationality, you can avoid being swayed by emotion or speculative trends. Staying grounded in long-term goals, focusing on fundamentals, and adopting a disciplined approach can help you thrive even during seemingly chaotic periods. Remember, rationality wins out over time. So while the market may remain irrational longer than expected, your calm and rational strategy will pay off in the end. Thank you for joining us in this discussion. If you found this video helpful, don't forget to like and share it with fellow investors. Keep investing wisely, and we'll see you next time.